Good afternoon, everyone. My name is Bill Fox. Welcome to another episode of Beyond the Noise. Our goal at the Fox Alliance is to offer insight into big economic themes. Our topic for today is the debt dilemma. This is the second part of our discussion. Last week, we covered the problem with debt, and today we'll be discussing potential solutions. If you missed part one from last Tuesday, we'll be emailing the recording for part one and part two to everyone. Today, we'll be exploring 4 ways that countries can get out of debt and viable steps that we can take before it's too late. Our panelists will speak for about 30 minutes, and we will have time for questions after that. As discussed before, our compliance department doesn't allow the chat feature. So if you have any questions for the end, you can email me at bill@thefoxalliance.com. Our presenters today will be Max Clark and Josh Renfro. Laura is under the weather today. Max will be our first presenter. Max, take it away.
Thanks, Bill. I appreciate it. As Bill mentioned, our objective today is to cover some of the potential solutions or kind of where do we go from here, since we addressed on the last part or the first part, kind of what the big problem is. And just as a reminder, this was the problem that we talked about, which is that U.S. total public debt is currently, as of Q3 2023, just over $33 trillion. That is a significant amount of debt. And the real question now is, where does it go from here? What are the steps or kind of what are the ways that countries as a whole can address debt? We're going to talk about 4 ways at a relatively high level. So let's start out with the first 2. I single these 2 out because the U.S. has some experience with both of these after World War II. You may remember from our previous conversation that the U.S. incurred a significant or brought on a significant amount of debt through the end of World War II. And then we saw that debt to GDP ratio decline significantly in the roughly 25 years following that time period, following 1947. And the 2 things that really contributed to that decline was, 1, pay it off. That's obviously the most financially sound strategy to pay off your debt. The U.S. did a little bit of that, which contributed to a debt reduction following World War II. The second strategy, though, which was the most significant contributing factor to our debt to GDP ratio declining so significantly, was growing our way out. Now, what does that mean? Here's a good chart that kind of demonstrates this. We're looking at GDP, debt, and the debt to GDP ratio. Debt is represented by the blue space there on the bottom. GDP is represented by the orange mountain chart. And then the ratio is the gray line. And you can see on the left-hand side, this is from 1947 through 1974, effectively 25 years following World War II. I single out this section because this is basically the time period when we went from well over 100% debt to GDP to our lowest debt to GDP ratio following World War II. So you can see there on the left-hand side, debt was roughly $250 billion, as was our GDP right after the war. And if you look on the far right-hand side, you can see that 100%, or we went down to 31% in the debt to GDP ratio. Debt held pretty steady and actually went down a little bit here in the beginning. So we paid some off, but it did gradually increase from mid to late 60s through 1974. The biggest contributing factor to that debt to GDP ratio reduction was the fact that our GDP increased by over 6 times. We went from $250 billion to right around $1.6 trillion. So to put this in a little different context, imagine that you are a household and you have a $100,000 mortgage and you have a $100,000 income. Obviously, that $100,000 mortgage represents a has a more meaningful impact on your financial security when your income is effectively equal. However, let's say that your income goes from $100,000 to $600,000 or $700,000. Well, now that debt, that mortgage that you have, is far less impactful or has far less of an impact on your financial security. And that's effectively what happens when you grow your way out of debt as a country. Your production as a country becomes more significant, and the debt pales in comparison to that. So those are the first two ways: pay off the debt and grow your way out of debt. And I would say that those are the only two options that are positive in nature. The next one is to default, which effectively means that you admit you are unable to pay your debt and you go through some sort of restructuring. This is a really negative outcome and something that we really believe we should avoid if possible. Couple of examples that occurred really in the last 10 to 15 years that you guys probably heard about. Argentina was the most recent back in 2020. They went through a period of debt restructuring where they defaulted basically on $65 billion of their debt and had to restructure that and come up with a solution. Greece was probably the most prominent example and well-known example back in 2012, and they restructured about $350 billion of their debt, effectively eliminating about half of it throughout that restructuring. Now, that all sounds well and good, but there are some real potentially negative implications from defaulting. One is you generally experience currency devaluations, which inevitably leads to inflation. You generally have an inability to borrow, and if you don't have an inability to borrow, at the very least, you have a significant increase in borrowing costs. So borrowing becomes, if you aren't unable to borrow, you have a significant increase in borrowing costs. And all three of those implications lead to economic slowing or collapse, depending on the significance of the debt that you defaulted on. So default is something that we definitely want to avoid and is something very negative as an outcome. But that is the third option. The fourth option is inflate your way out of debt. And approximately 100 plus countries have chosen this route over the last century, or I think a better description might be that they were forced into this route. But what does that really mean? What does it mean to inflate your way out of debt? Well, think about it this way. If a country has $100 in debt outstanding and they choose to use $100 from their budget to pay off that debt, they're doing so with $100 that they could spend on other goods and services. That $100 basically has $100 worth of purchasing power in today's dollars. But let's say over the next 3 years, inflation is really high and prices double over the next 3 years. Well, that $100 that you were going to use to pay off the debt today is only worth $50 effectively in the future in terms of purchasing power. But the value of that debt doesn't change over that time. So in the future, if you do experience high inflation, you have the ability to pay off that debt with less valuable dollars. But how does that work? How does a country accomplish that? Well, they seek to experience or promote inflation in the economy. And really what you do as a country is you seek to increase the money supply. You increase the number of dollars sloshing around in the economy. For governments, that's a valuable thing because as the number of dollars increase, you have the illusion of prosperity in the beginning, and it also increases the tax base, and therefore the government ends up seeing an increase in their tax revenue in actual dollar standpoint. So then they're able to have more dollars they can use to pay off their debt. You raise the monetary base or the money supply by doing a couple of things. One, you could embrace loose monetary policy where you've got really low interest rates and you promote a higher inflation, kind of a gradual inflation over time. Another option, which would be probably more aggressive and faster, would be print money. And certainly countries have done that over time as well. But playing with inflation is like playing with fire. It's something that you really want to avoid. And when you look at, the 100 plus examples over the last century of countries doing this, there can be some real negative implications because inflation has a tendency to get out of control. And I think that's one of the reasons that the Fed has been very aggressive in combating inflation over the last couple of years here by doing everything that they can to reduce inflation in our country. But the negative implications to hyperinflation would be that it really can destroy the capital markets. It can set economies back generations. And ultimately, your currency becomes practically worthless. We'll talk about some examples here. I think it's important to look at these examples because it puts our recent experience in context. A lot of us have been feeling the effects of higher than normal inflation, and we can feel like this has been a pretty high period of inflation. But when you look back at historical examples, the inflation that we've experienced pales in comparison to what some of these other countries have experienced. And we're going to look at these examples to just give us an understanding of the real negative impacts that could occur from hyperinflation. Now, what this chart shows is the 10 worst, highest monthly inflation rates. Note that we're looking at monthly inflation, not annual inflation, highest monthly inflation rates, really over the last century. By far, the worst example was Hungary back in 1946. They experienced a monthly inflation rate of almost 42 quintillion%. Those are astronomical numbers. Essentially, what they had was an equivalent daily inflation rate of just over 200%. Prices were doubling every 15 hours. That is obviously unsustainable and extremely painful for a country. Zimbabwe is the second worst experience. They had a highest monthly inflation rate back in 2008, this century, of 80 billion%. Prices were doubling every day. That is ridiculous. And we talk about the fact that hyperinflation effectively makes your currency worthless. Take a look at this. This is a $100 trillion bill from the Reserve Bank of Zimbabwe. Obviously, when you're issuing $100 trillion bills, your currency has deflated or has significantly inflated, and you're having real problems as a country. This is what hyperinflation can lead to. And this is why we say playing with inflation is like playing with fire. And it's something that we really would like to avoid if possible. So those are the four options. The first two being very positive, pay off your debt or grow your way out of debt. And the last two, default or inflate your way out, really aren't positive. So what do we think the likely outcome is going to be for our country? Well, on the current trajectory, we think our most likely route is probably going to be inflate our way out. I want to say very clearly, we don't like that route. That is not something that we condone or promote. But based on the level of spending that we're experiencing as a country and our complete disregard for taking on additional debt and having it really impact our country, it seems like the most likely way out for us as a country. Now, the one caveat is that we're highly innovative, and innovation often leads to productivity increases. And when productivity increases, it allows us to really experience growth in the economy. So there's a small possibility that we could grow our way out. But in order to do so, we would need to take some pretty drastic actions to reduce spending. We're currently spending $1.5 trillion more per year than we're taking in. When you have deficits like that, there's no way we're going to grow our way out of the debt. So really, the next question for us is, how can we avoid inflating our way out? What actions can we take now to get out of this situation and to avoid going into a hyperinflation scenario? I'm going to turn it over to Josh now to talk through this and walk through some of the actions that our government could take to address this situation. Josh?
Thanks, Max. So there's a couple of things we need to really think about. And once again, Max has outlined, we have a couple of potential areas that could really help us to make differences. And so I want to talk about, we talked about in our last webinar that there are several key areas that take up the lion's share of their budget: Social Security, Medicare, Medicaid, interest on the debt, and defense. So one of the things that we really need to think about is how can we ultimately reform some of these really big spending priorities that we have as a country. So Social Security, there's a number of ways that we could ultimately choose to reform Social Security. We could push back the full retirement age. We could raise taxes on Social Security. Specifically, the most likely option there is that it would occur for higher earners. Means testing. If you have a means of a certain level, you don't get to use Social Security. And then lastly, we could look at phasing out the program for younger people. We are going to have to deal with this issue. Social Security, as I mentioned in our last webinar, is an area where, because life expectancy increases are actually an unwelcome surprise here, it can dramatically increase the costs that we as a country are having to face when it comes to these particular areas. And so this is an area we're going to have to make some serious decisions on. I do think our country will be forced to make some decisions on this. In about 9 to 10 years, we're expecting the Social Security Trust Fund to run out. And I think it's likely that political pressures at that point will promote a conversation. We need to hope and work hard to make sure that the people who are elected at that time really make sure that we do a serious reform. And ideally, honestly, I would hope that we could ultimately phase out Social Security for people in my generation. I think that would go a long way towards helping that, because as I mentioned last time, 94% of all current tax revenue goes towards Social Security, Medicare, Medicaid, defense, and interest on the debt at this point. So Social Security, those are 5 major ways that you could look to reform the system. One other really interesting thing here, this chart shows just one really, I think, a pretty ingenuitive idea, which is, what if we took Social Security and we created the starting age that you could take Social Security was based on a index based on life expectancy. So basically, as life expectancy increases over time, we have to wait longer in order to start taking. And if we could do that, according to this study, we would see roughly a 50% reduction in the fund's deficit over time. So that's just, once again, I think this is really important. While the situation is dire, there are absolutely still things that we could do that could materially increase the runway that we have to fix the problem. This is one example of a potential solution that could be pretty meaningful. The next major area is Medicare and Medicaid reforms. We talked about last time, within healthcare, people just are not incentivized to care about costs. And so one of the first things we could look to do is actually align incentives for patients, and I would also add the government, to actually promote cost savings. Whether that's making sure that there's more co-pays in place, or maybe a system where individuals receive money back from the insurance company if they're able to keep the cost of certain procedures below a certain amount. There are a number of ways that you could ultimately choose to do this, but our current system does not promote cost saving. We could also increase Medicare taxes. That's obviously another option. Third, we could increase the age at which you're actually eligible for Medicare. And then there are other cost-cutting ideas that we could consider as part of the process. The Department of Defense, we talked about some of these areas in our first webinar, getting rid of cost plus budgeting, this idea that you basically get a profit based on your cost as a percentage, ultimately a system that doesn't align incentives with actually producing good, high quality weaponry, with also being considered to the budget. And then the other thing we really need to be cognizant of is ultimately getting into wars. As we talked about last time, you're just looking at the war in Afghanistan and Iraq. Between these wars, we're looking at somewhere between $5 and $7 trillion of cost. And that's just the monetary cost. Forget the cost when it comes to the loss of human life, the amount of individuals that died, and everything else, and the more moral consequences. But just purely from a financial consequence, it's substantial. We really need to make sure that if we get into conflict, we do so in a situation that is truly meaningfully beneficial to us over the long term, because the costs will be quite high. Now, really, there are 4, Max introduced the first framework, which is really, there's 4 ways that you could ultimately choose to tackle debt. And then there are really 4 methods that we could then use within the different contexts to help that. So the first of which is cutting expenses. The second is raising revenue. So let's talk about cutting the expenses side. We could create a new budget/spending program for agencies to align incentives with the efficiency and the desired results that we have. And so, if we could actually create a system that allowed and rewarded agencies for being more efficient with the dollars that they had, that could go a long way towards actually making sure that we don't have a lot of wasteful spending. And while I'm definitely in favor of choosing to do things like that, the one caveat I will put on that is, remember, only about 20% of the budget, or 25% of the budget currently, does not go to the 5 major areas: Social Security, Medicare, Medicaid, defense, and interest on the debt. So while we want to optimize that 20 to 25% and make it as efficient as possible, we have to remember that ultimately reforming the holy cows of the government are the things that we have to focus on if we really want to see meaningful progress here. Now, one area that I'm actually really excited to see what the impact could be over the long term is medical innovation in healthcare. There are a number of diseases, cancer, hypertension, amongst others, that literally cost the Medicare system tens of billions of dollars every single year. And a number of these conditions, medical research is on the cusp of major breakthroughs in helping to treat these things. And in long term, it will result in the treatment of these things to become a lot less costly. So this is one example of how powerful innovation is. Innovation is powerful in multiple ways, but in this way, it's powerful because it can take what today is a very expensive process and could make it a lot more simple. Now, the challenge with that, though, also is this. If we do see these medical breakthroughs, what we probably will also see is an increase in life expectancy as well. And so the challenge is, once again, that continues to push out and make the cost of Social Security even larger, only further demonstrating the need to reform this system. And the third area ultimately is to reduce the size of government, which we really covered and talked about here in the first point. Now, the second thing, though, that we really need to think about, and this is not a popular topic to ever talk about, but it's raising revenue. At the end of the day, we need to cut costs. We need to reform some of these incredibly expensive things that we're paying for. But we're getting to the point now where we are also going to have to raise revenue, because the expense of just the interest alone is getting so expensive that there is only one way to get things out. As a financial advisor, I oftentimes, unfortunately, have to talk to individuals that the amount of debt that they've accumulated is so much that their income simply can't handle it. And the only way they'll ever really be able to get out of it is either to declare bankruptcy or to find another job where they can make meaningfully more income. And that's exactly the situation that the US is starting to find itself in. So the first way is to ultimately raise taxes. As I said, a very unpopular approach to doing this. But we are fast approaching, regardless whether you're a Republican or Democrat, that we will have to ultimately increase taxes in conjunction with spending cuts and reform in order to actually make a meaningful difference. Now, not all taxes are created equal. It's important that we really think about the kinds of taxes that we roll out. Something like a VAT tax or even a national sales tax are much more preferred than income taxes, because taxation is ultimately going to be negative on the economy. For every percent you increase taxes across the economy, there is a historical relationship where the growth of that economy slows. So if you're going to increase taxes, you want to make sure that you try to minimize the effect as much as possible. And one of the best ways to do that is to make sure that we are ultimately de-incentivizing the right things and incentivizing the right things. The challenge with a standard income tax is, what does that do? It ultimately gets to the point where people have to decide whether they want to continue to make money or not. A great example of this would be Ronald Reagan earlier in his acting career. He chose to generally only make 1 to 2 movies a year because the tax rate got so high, he'd be paying 70 to 80% in taxes, and it just didn't make sense to continue to work. We do not want to promote a tax system that encourages people to not be economically productive. And so something like a sales tax or a VAT tax would probably be one of the more efficient taxes that you could ultimately implement. Now, one of the other ways that we could dramatically increase revenue is the US government actually has a very large set of assets. And those assets are largely natural resources. If you look at government-owned land, there is a lot of oil, natural gas, and in some cases, rare earth minerals that are located in these locations. If we as a government could start to take a more active approach in terms of developing these resources and seeing them ultimately sold on the open market, that could materially produce a large amount of revenue that could ultimately help to deal with the current debt crisis that we're facing right now. Now, the next area is promoting growth, and Max already alluded to this. If you have the ability to increase your economic growth and grow your economy over a long period of time, that can be one of the most powerful forces towards ultimately making the debt much less impactful. The challenge is, though, your growth rate has to be large enough that it can actually begin to outpace the growth in your spending. So coming out of World War II, we had about $250 billion of debt at that point in time. When our economy grows by 6 times over 600% over a 25-year period of time, that's huge, because suddenly now, instead of, as an example, instead of having a 10% tax on $100 and you're generating $10, now if your economy's grown to $600, you're now getting paid $60. Your tax base and the taxes you've collected have gone up 600%. The challenge with this area is that, if you look back during the times of Reagan as an example, economic growth was commonly in the 4, 5, maybe even 6% range, which means that we were seeing our economy double in size roughly every 12 to 15 years. Today, economists are happy if we see a 2 to a 2.5% growth rate. 3% is considered incredibly difficult to accomplish. And that means that we're not seeing a doubling of our economy except for maybe every 25 to 30 years plus on that side. And so there are limits when it comes to that. So one of the meaningful questions to ask is, how could we increase economic growth? How could we actually see the tax base grow big enough that it could begin to make up for some of the really crucial mistakes that we've made over the last 20 to 30 years as a country? The first of which is promoting innovation. So things like artificial intelligence, 3D printing, low-cost energy. And there's a whole slew of other areas that we could talk about here. But if we can really promote growth in these areas, these can increase the productivity of our existing workforce and can create a massive amount of wealth. The challenge is this: productivity increases can take us a good chunk of the way, but so much of our economy is already in a good economic position. As far as nations go, we are the wealthiest nation on the face of the planet. You got countries like China that still grow at 6 or 7% a year. Why? Because there's a large chunk of their population that are still largely impoverished, or at least in poverty. And so one of the other things that we would strongly encourage people to consider is promoting legal, merit-based immigration that can reasonably be absorbed. Why? Because you begin to take what allows for some of the larger scale growth in these more emerging market countries, and you begin to import it here into the United States. We need to see the amount of workers in our population grow, and more people spending and consuming and living in our economy. If we could do that, that could meaningfully begin to increase economic growth. In fact, if you look at the economic growth that Max talked about earlier, what was some of the biggest causes of that? It was because of the mass immigration that we saw during the Ellis Island generation, the melting pot that took place. These were some of the things that really pushed the needle in a big way. The fourth and last thing we wanted to just talk about is getting creative. Now, I would say of everything we've talked about so far, this is by far the smallest impact of anything that we're going to discuss. But there are some creative things that could make a meaningful difference and buy us some time to continue to fix this problem. The first of which is consider issuing ultra long-term debt when interest rates are really low. Regardless of what your opinion is of Donald Trump, one idea he threw out, which I think was actually a brilliant one, was considering issuing 100-year bonds that, when interest rates are really low. If we had taken his advice and locked in a large chunk of our debt on 50 or 100-year bonds at 2, maybe 3%, we'd be in a situation where, as interest rates increase right now, it would not cause the interest payments that we're paying to go up, or at least not to go up nearly as materially. Future administrations would do well to try to take advantage of this kind of opportunity if interest rates go back down to a lower level in the future. The second thing that we really do believe is really important is creating mandatory financial education in high school. And probably of all the ideas that you've heard us talk about today, you're like, why is this on the list? If you think about the largest cost items in our budget, and I'm going to specifically pick on two: Social Security and Medicaid. Medicaid is a government health insurance basically for the ultra poor amongst us. Why do we have to have these systems? These are social safety nets designed to, catch individuals who've gone through really hard times in their lives. we as a nation are very financially illiterate. It's not taught in schools, at least elementary and high schools. It's not largely taught in colleges, and parents rarely teach it. And as a result, we have a very financially illiterate population. If we could promote financial literacy and education at earlier years, how many more people would not get to the point where they had to rely on Social Security to be able to retire? How many people would actually have good paying jobs at good incomes where they wouldn't have to rely on Medicaid for their health insurance needs? If we could promote better individual responsibility, it could put us in a position where we could limit the scope of these social safety nets where the costs wouldn't be nearly as extreme and as large as they are today. So just in wrapping up, while the problem is very dark, we do believe that there are substantial things that can still be done. I still believe that this ship can be turned around. Now, there's a big difference between believing it can be turned around and believing it will be turned around. We are ultimately going to have to face some very severe pain. But my hope is that in the midst of experiencing that pain, we will consider some of the solutions that we've talked about here. But to reiterate, there are two things that must happen. Two things that must happen. We must first see substantial reform in the 3 or 4 largest expense items on the budget. We need to reform Social Security, Medicare, and Medicaid. We need to get these expenses to a level that is something we can actually bear over a longer period of time. And then the second area that I would say is an absolute must is we must continue to be the economic powerhouse of the world. We must continue to promote growth as a country. If these two things do not happen, then it is going to be very difficult to find a situation that will work, that will ultimately not be incredibly painful along the way. And so with that, we'll open things up to questions. I will say, just as a note, we are planning on doing a special Beyond the Noise episode here in about 4 weeks on the Houthi rebellion and the trade blockage that's been taking place because of the violence there in the Middle East. So if that's of interest, feel free to tune in 4 weeks. But with that, we'll open it up for questions.
So the first question is, what percentage of Social Security SSA payment go to people taking early benefits, like before they're eligible for full benefits? Who would like to take that one?
I can take that one. So I don't know the specific percentage when it comes to that, but the one thing I will say is that's actually probably generally a pretty positive thing in terms of the solvency of the Social Security system, because oftentimes those benefits, the benefits are heavily discounted. So a person who takes it 62 versus 67 are commonly going to see anywhere between a 40 and like a 45% discount on their benefits compared to if they waited till full retirement age. So while it does result in an initial increase in the amount of money that you would get, that on a actuarial basis ultimately tends to work out pretty well for the government, albeit in the short term, not quite as well.
I did see some numbers on that recently, Josh. It was well over 50% of claimants took their Social Security prior to full retirement age. So it's a pretty sizable portion. Most of them, the highest number of people, I think it was over 25%, claimed at 62. So there's a very large chunk of people that claim early.
All right. All right, next question. If other government agencies own our debt, isn't that just a double debt situation? Josh, would you take that one?
Sure. Fascinating question. And the answer is yes, it is. Because when we've just been talking about the problem as a debtor, as someone who owes the money. But when you consider the fact that we own the debt that is problematic, it puts us in a position where in the future, almost all the solutions outside of paying off the debt itself ultimately result in effectively robbing the person who you've borrowed money from, whether that's through the form of default and literally not paying it all back, or whether it's through inflating the value of that debt till it's virtually worthless. All of these methods are bad for those who actually hold the debt. And so, this is one of those things, investors are going to need to be very, very cautious about holding nominal assets, cash, and bonds if we really start to see inflation kick up in a meaningful way, because those are the assets that are really, it's inflation. What is inflation? Inflation is really a unauthorized tax. It's a tax that Congress doesn't vote on, you don't vote on, but that's what it does. It ultimately takes away purchasing power from the most conservative amongst the population and gives it to whoever ultimately is the recipient of the money, which the government ultimately is in a longer term sense. So that is an important thing to think about. Is our problem is not only the fact that we owe a lot of money, but that we actually owe a lot of that money to ourselves.
Okay. Next question. Why do you think the government didn't create 50 and 100-year bonds 2 years ago when interest rates were incredibly low? Who would like to take that one?
Go ahead, Josh.
At the end of the day, I think honestly, the fact that the person who actually suggested it was the problem. At the end of the day, Donald Trump's approval ratings were really, really low at the time that he suggested it. And I think at the end of the day, you didn't have more moderate minds also, chiming in to say, hey, this would be a really good idea. So I think the political environment was the bigger issue. I have since then, though, seen a lot of individuals that have recognized the merits of considering those options. And I think if we were to see an environment like that again, which, maybe it's not quite that low, but is it possible we see interest rates come back down during a time of crisis again? Yeah, I think that's a realistic possibility. If that's the case, I think there's a good chance that we could see more bipartisan support in actually creating 50 or 100-year bonds. Now, the real question, and this is the question we don't know the answer to, is would there be enough demand for them? Would there be enough demand to buy 50 and 100-year bonds? If the central bank is involved, probably, because they don't really care. They aren't buying things really for themselves. They're buying things in order to promote a specific result. So if there was a lot of central bank activity, I could see a 50 and 100-year bond potentially gaining some steam. I've got some questions about whether there would be enough demand for a 50 and 100-year bond from just the private markets in general.
Have you seen, we have other countries doing those 50 and 100-year bonds. Do you know what kind of demand there was there?
It's a great question. I don't know the answer to it. I'm fairly certain that they were subscribed, but they also were fairly small in terms of what those offerings were. And they also still offered fairly high interest rates because most of those countries don't have nearly as good of economies as the US did. And so for the US, for this to make a meaningful difference, we'd have to be trying to refinance, in the neighborhood of 5, 10, 15 trillion dollars for it to make a real tangible difference. From a payment standpoint long term. Obviously, anything would help, but if we wanted to make a really material difference, we'd have to have a lot of bonds get issued at those levels.
All right. Next question. Is there ever a time for the government to go into debt, or is all government debt bad? Max, would you take that one?
Sure. Yeah, it's a great question. And, I think generally speaking, broadly speaking, if we're painting with a broad brush here, our perspective would be debts from a government standpoint is not a good thing. In most instances, let's try to avoid it. But I'd say there are probably two scenarios where it makes a lot of sense for the government. One would be if you find yourself going into a existential crisis, where you might say be in a war or going into something where your people are threatened. Taking on debt to address that can make a lot of sense as long as you're going to ensure that you address it afterwards and pay that down as quickly as you can. The second area would be if there's some sort of infrastructure or other type of project where you're going to issue debt specifically for that, and that project will pay that down itself over time. It's going to create some income or create some cost savings that will allow you to be able to pay that debt down. I think that makes a lot of sense as well. But those are two pretty specific scenarios. Otherwise, we need to function in a financially wise way as a country and ensure that our outflows don't exceed our income. That is really the best way to operate a country and can avoid a lot of the problems that many countries around the world have experienced.
Okay. Next question. Are we likely needing to move to a wealth tax? Who would like to take that one?
You want to go ahead, Max?
No, go ahead.
So once again, taxation is a system that promotes certain activity and it de-incentivizes other activity. So the question is this: if we created a wealth tax, one, what would the impact ultimately be? And two, what does it incentivize or de-incentivize? So part of the challenge of a wealth tax is, one, how do you value everything? Now, if everything's on the stock market, okay, it's a little easier to value, but a lot of the individuals who are really wealthy in our country, um, their assets are in private businesses or private pieces of real estate, which are very, very difficult to value. So the first thing I would say is just the actual technical execution of a wealth tax would be very, very challenging to do. And as a result, you'd probably have to create a much greater logistical infrastructure within the IRS, which would ultimately increase costs further. But the second thing is, you do not want a wealth drain. You don't want a situation where people choose to leave the United States and go other places so that they're no longer taxed. We have not seen this by and large because the US tax system is still bearable. And compared to other places like Europe and some other countries, our tax rates aren't as high. But you still see it commonly. As an example, right before Facebook went public, one of the big executives renounced his US citizenship so he wouldn't have to pay capital gains and income taxes on a massive scale. So I tend to think that a wealth tax specifically is probably not the way that you would want to go, because we don't want to incentivize people just having money or de-incentivize people having money. What we want to make sure is that taxes are incentivizing the right things and de-incentivizing other things. So I think a lot of the tax ideas that would be generated would still focus on the wealthy portion of the population. But if we could do so in such a way where we're promoting them to do certain activities and not the thing is this: the people that are the most wealthy amongst us, not always, but in a large case, a lot of them are entrepreneurs. They're people who build companies. They seek to spend money to try to innovate. We want to promote that. And if you just have a tax because, hey, you're wealthy, then what does that promote? It promotes people not to get to that point nearly as much. Versus if we say we're to have a tax on consumption, what does that do? That promotes the wealthy maybe not to consume quite as much and to spend more money on investment and growth and other things like that. So if you are going to have a tax that is specifically focused on the wealthiest portion of the population, let's make sure we're trying to incentivize them to do the things that are going to help us the most and de-incentivize them from the things that help us the least. And I would just in general say a wealth tax is not something that will actually do that. There are other ways, if that's the way you're going to go, that you could ultimately try to target that kind of a tax.
I think kind of a good case study of this, Josh, not that any state has necessarily imposed a wealth tax yet, but you can look at the way various states have handled their financial situation. There are several states who have seen a huge outflow of wealthy individuals because the tax burden is unbearable. And ultimately, while politicians think, hey, that'll be helpful, we can raise revenues, it exacerbates the problem because you've got a huge outflow of wealthy individuals who used to contribute to the tax revenue, but no longer do. And
California is a great example of that, right?
Yep.
I mean, we're seeing one of their largest deficits this year because of that exact fact. And so that's why when we do look to, if we're going to take the tax increase route, which I think we will at some point, we've got to very carefully do it and make sure that we're not putting ourselves in a position where we're going to chase off a large portion of the people that we need to be here to continue to pay those taxes to help us get out of this problem.
All right, that's all the time we have for today. Thank you to our presenters, Josh and Max. Just want to remind everyone, we have a special bonus episode in about a month from now on the Houthis. I think that will be interesting. But just want to say to everyone, have a great week and look forward to seeing you to our next Beyond the Noise webinar.